Hello and welcome everyone to today's Associates Meeting at SIEPR. We're starting a few minutes late, and that's entirely my fault. I got too engrossed in conversation, but delighted to have all of you here today. I'm Mark Duggan, the Trione Director of SIEPR, and it's great to see so many of you here for what I know is going to be an excellent presentation from my friend and San Francisco Fed President, Mary Daly. I'm also looking forward to seeing many of you in just 16 days on Friday, March 8th at our annual Economic Summit. We have a really terrific lineup for the day, including a dinner keynote presentation by a person I believe who is Mary's boss, Jerome Powell, the chair of the Federal Reserve, and you can find more details about this event on our website. We also have lots of other things in the work right now at SIEPR, lots of new research that we'll be highlighting and sharing with you in the coming days that looks at things like policy failures in granting benefits to veterans, military veterans, policy considerations for curbing opioid abuse, and much more. So you'll be reading about all of that in stories in the coming days that should be heading your way. And all of that work is happening in part because of the support from many of you here in this room, and I'm really extremely grateful for that, and I'm looking forward to sharing more details about that in the months ahead. But today, I'm especially thrilled that Mary Daly, Dr. Mary Daly, is with us. She is relatively new to her job as the President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. She started that position this past October, but she is no stranger to the SF Fed, having joined in 1996. And she's been serving as the bank's executive vice president and director of research since December of 2016. And I learned today when we spoke that by far there are 12 districts for the Federal Reserve in the US, and the San Francisco one is by far the largest, representing 20% of the US population, including 9 states. And one of those states is Hawaii. So I thought, when we were talking today, I thought that that Mary should embark on a detailed analysis of Hawaii's economy, and if she needs any Stanford professors to assist her in that endeavor, I would be very, very happy to help. But Mary, more seriously, she is, beneath all of her titles and her position at the Fed, she's a voting member of the Federal Open Market Committee. She's one of the country's top labor economists, and she adds quite significantly to the Fed's arsenal of expertise as someone who understands labor markets inside and out. She's at the forefront of thinking about how automation, inequality, and rising interest rates are going to impact jobs and the lives of millions of Americans. I first met Mary more than a decade ago at a conference, given our overlapping research interests, and I'm really proud that we are now working together on a paper on supplemental security income, an important safety net program that we are somehow going to finish between now and the next couple of weeks. So looking forward to that. She's often called the people's economist and has been recognized for her efforts to make economics more accessible to the public. She produces podcasts and uses social media to connect economic principles with real-world concerns. She often speaks with educators and college students about careers in economics to help inspire young people to enter the field, and is very committed to seeking out and including many different perspectives when it comes to understanding and assessing the economy. And she's championed the need for more gender diversity and inclusion in the field of economics. I think part of the reason for that commitment is grounded in her own background, which you could certainly call an untraditional path that led her to the Fed. She dropped out of high school when she was at the age of 15 and worked in, I believe, a donut shop and a Target before getting her GED. She then worked her way through the University of Missouri, Kansas City, where she earned a bachelor's before getting her master's from the UIUC, University of Illinois Urbana-Champaign, and received her PhD from Syracuse, and then completed a National Institute of Aging postdoctoral fellowship at Northwestern University. So there are many different dimensions to Mary's story, but I'm really so delighted that she is here with us today. So please join me in offering up a warm welcome to Dr. Mary Daly. Thanks, Mary. Yeah.
After that, I always worried I'm going to disappoint, but I'm going to give my level best. So when Mark first asked me to come to this event, he said, I said, what would you like me to talk about? And he said, well, I'd like you to talk a little bit about your personal story. That'll be very interesting. A little bit about what the Fed does. That'll be interesting. What the Fed's currently thinking about, and then how you're thinking about it. So that's a big talk. So what I decided to do was do a little bit of all of that, and then Mark and I are going to have a fireside chat a little bit before we open it to Q&A. So I'm going to start with the part that Mark talked about, which is tell you a little bit about who I am. And the reason that I think this is important is because it tells you a little bit about how important diversity of thought is when you're thinking about policy making. So I started out in Missouri. The red star represents St. Louis, and I grew up in Baldwin, Missouri, which is west of St. Louis. And I'm the daughter of a postal worker. My dad was a postman, and my mom was a stay-at-home mom. And the important thing about us is that from the outside, we looked like we lived in a modest but well-kept home, and that we were lower middle class. But from the inside, we felt like we were one economic or health shock away from falling through. In Missouri terms, we lived pretty close to the bone. That's how we used to think about it. And when I was 15, we had those shocks. We had health shocks, economic shocks, and we fell through. We just completely fell through. And the way that I think about it is my family more or less just imploded. And I went off to live with friends, and my siblings, 3 of them younger, went off to live with my grandparents. And I dropped out of school because I was trying to work to support my family, but also when you're 15 and your family implodes, you don't actually think about, well, I need to go to school and I need to study math. You think about, how do I get a job? How do I make my way? So school was the last thing that was important to me. And I was fortunate enough, as many people in my situation are not, I would offer, but I was fortunate enough to have someone take an interest in me, a mentor. And she was the friend of my high school guidance counselor. So when I dropped out, I didn't know what to do. So I go to the guidance counselor and I tell her I'm dropping out. And she says, well, I want you to meet my friend Betsy. So I met Betsy. Love Betsy. So Betsy, she just, to just put it in context, Betsy was 35 at the time. So this is just mind-blowing to me that she's 35 at the time, and she somehow takes an interest in me, and she sees something in me that I cannot, at that point, see in myself. And she encourages me with these gentle nudges to go to get a GED. And I'm working at Target, as Mark said, in a donut shop, and I think, well, this will be good, because if I get a GED, I can get a union job and I'll get health insurance, and maybe I'll have 1 job instead of 2 jobs, and that'll be good. And maybe I can start on the night shift and work up. So I say yes, and I get the GED, and then she says, with a GED, you could take a semester of college. And I didn't even know what college was. I never, in my experience, I mean, my professors, high school teachers and things, they went to college. But we never talked about it. It wasn't part of the culture in my community to talk about college. And most of the people I knew worked in jobs where college was not required. So I said, why would anyone go to college? What would I do there? And she said, well, just try it. So I went to college 1 semester. She paid for it because I didn't have the money. And she paid $216. And for all the parents in the room, that was for the whole semester. But I went to college, University of Missouri, St. Louis, and I did pretty well. And she said, you could get a 4-year degree and you could move a little farther from home. So I went to University of Missouri in Kansas City, which was 4.5 hours from where I'd grown up. And that's where my journey started. I started in psychology and philosophy and then fell in love with economics. In part because I had a great professor who taught me that economics was not just the study of math and models, but the study of people and behavior, and that I fell in love with. So I get my degree in economics and philosophy, and I go on to University of Illinois in Champaign-Urbana, and I get a master's there because I wasn't really sure what I wanted to do yet. So then I end up at Syracuse getting a degree. But in my journey, I'm studying labor economics and public policy. And I come out of my degree program, I go to Northwestern for a postdoc, a National Institute of Aging postdoc, I'm studying disability, and the Federal Reserve Bank of San Francisco hires me. And it's the weirdest thing, right? I'm working in an institution that does macroeconomics and monetary policy, and I'm a microeconomist doing public policy. And I felt a little bit like a fish out of water, but I also felt like, and here this won't, well, it'll still resonate with you. I get my job, and I am surrounded by people who went to Harvard, Yale, Princeton, Harvard, Yale. I always tease if they're slumming it, they went to Berkeley. but they really, I'm the only person who hasn't gone to a top 10 school for any of my journey. And what was important, and it was relevant for the story about how this affects my public policy making, is I got my degree, I finished at Northwestern, I get my job, I walk through the doors of the San Francisco Fed, and I never tell this story. I become Mary Daly with a PhD, doesn't matter where I came from, and I remember telling people I went to Northwestern to finish up because that was the last place I had been, so it wasn't a lie, but it wasn't exactly the whole truth, right? And so, and this was actually something that nobody minded me doing because they were already a little, you know, one of my bosses told me when he hired me, if you fail and you're from Syracuse, I'm the bad guy. If you fail and you're from Harvard, you're the bad guy. So I was like, okay. You know, so people took a risk on me, and that was good. But so I spent a large fraction of my early career not telling people a word about my story, nothing I've shared with you tonight. And about 6 or 7 years ago, a woman named Gina Smilik asked if she could do a profile of me. She's at Bloomberg News, and at the time, Janet Yellen, who was vice chair at the time, if I've got my math right, she was speaking at Jackson Hole, and she cited my work on wage rigidities and how that was affecting the recovery of wage growth. And so Gina found out about my background a little bit. I don't really know how, and she found out a little bit about my work, and then she saw that Janet was referencing me, and she asked if she could do a profile. So I said, okay, because I didn't know what a profile was. I actually thought they were going to talk about my research. I was like, yeah. So she comes and she does the profile, and she starts with my research, and I'm all in. Then she asks me about my family and my background, and I'm like very uncomfortable, and I'm, you know, it's just minimized, don't talk about it. But she gets all the details. She has to even speak to people in my group, in my family and my friends and Betsy. And then she goes back to my research. I'm happy again. And yeah, it's really like an emotional roller coaster. And she gets to the end, and she says, okay, Mary, so to what extent did your upbringing affect your work? And I said, I didn't even miss a beat. I said, not at all. Not in the least. And she totally met me with complete silence. And Gina has this really great tell. When she thinks you've given her an answer and she's ready to move on, she says, great, good, really good. She said nothing, zero. And with this silence, I had a moment to reflect on how absurd my statement was. Because I studied income inequality, labor markets, unemployment, the black-white wage gap, all these things that, of course, were affected by the experiences of my early childhood. And it was that moment that I had this epiphany, that I had been leaving half of myself behind, that I'd come to work as someone who I thought everybody wanted me to be, in exclusion of who I actually really was. And at that moment, I decided that I was going to really think hard about who I was and who I was going to bring to work. And not at the expense of my scholarship, not in any way, but at the perhaps amplification of my scholarship. And to be honest with you, my career started to take off because I was more self-assured, I was more confident, I was able to see how the work that I was doing was indeed affected and still hold myself to these standards. And the journey then, it started to take off, and I ended up as, you know, the Federal Reserve Bank of San Francisco Research Director. Then I became the president. I'm at the FOMC voting, and now I'm at Stanford. So. But what I want to leave you with tonight, and this is what the rest of my slides are going to be about, is, you know, how does that affect what I do as a policymaker, and why should we want all kinds of diversity at the table, not just diversity that looks like me, but diversity that looks like all kinds of people. And so I thought I would do that in the remainder of my talk just by talking a little bit about what the Fed does for those who are not completely familiar, but then talk about a real issue, we're wrestling with many, but a real issue that we're wrestling with right now and how we're all approaching it, but more importantly, how I'm approaching it. So let me do that first by talking about, you know, what the Fed does. So if you don't remember your macro 101 or 301 or whatever, it's, you know, we really are responsible for three core functions. We have a safe and sound payment system, a safe and sound financial sector, so that's bank supervision and financial regulation, and then of course monetary policy, and the goal of monetary policy is to create a healthy and sustainable economy. And Congress gave us two goals to ensure that that monetary policy part was being executed. That first goal is maximum employment, and the way that we talk about it when we're talking just in general terms is everyone who wants a job has a job. I don't want you to take that so literally because there are skill mismatches and other things, but basically we want to fully employ the people who fully want to work and don't want to be in leisure time or taking care of children or whatever else they're doing. And the other part of our dual mandate is price stability. The dollar holds its value. We want the dollar to not lose value overnight and you have to wheel in wheelbarrows of cash the next day because we've got too much inflation. So those are our dual mandate, and we have really, the way I like to say it is we have two mandates and one tool, and it's a blunt tool. We have the interest rate. So we move one interest rate, and we hope other ones move with it. And when we move the interest rate, the mechanism by which this works is it changes financial conditions. You raise the interest rate, financial conditions tighten. That affects spending and output, slowing it down, the growth of those things, which ultimately affects employment, which ultimately affects inflation. So if we have higher unemployment, inflation generally goes down because we think supply and demand work. If there's an imbalance of people who want jobs and people who want to hire you, then your wage growth will go down and that affects inflation. And so that's the mechanism by which this works. And this is all part of the monetary transmission mechanism. And there can be wedges, as we like to say in economics, there can be wedges that form at any point in time. You can have a wedge form between our interest rate and financial conditions, or financial conditions and spending and output growth, or all the way to employment. The one I want to focus on today is the seemingly new wedge that's formed between employment and inflation. And that's what I want to spend the rest of my time on. So let's think about that wedge by just starting out with what the standard model would tell us. If you think about a reduced form Phillips curve, which is just the relationship between unemployment and inflation, whether it's price inflation or wage inflation, the basic idea is that you have this balancing act, this scale, so that when employment goes up or unemployment goes down, inflation would go up and vice versa. And that's a really great thing. It would kind of be exhibited by this. The classic model is if more people are pushed onto the sidelines, this is my version of them on the sidelines. So unemployment goes up, then inflation goes down. So we're in a recession, essentially, or a slow period in the economy, a bust. So that's the downside. Then on the upside, the opposite happens. Those people jump into the labor market, things start to heat up, and we get a rising inflation rate. And inflation goes above where we'd like it to be. And we're trying to create this Goldilocks economy, which is right in the middle, where you get this balancing act, where we're hitting our 2% inflation goal or target, and we've maximized employment in the economy. And so we've hit both of our dual mandates, and the world is where it should be. Now, the problem we have right now is that maybe it's a problem, maybe it's a feature. I don't know if it's a feature or a bug, but the situation we have now is said in like classic economics language, the Phillips curve is really flat. Said in more layperson terms, we have unemployment currently below the consensus estimate across almost every estimator of what the natural rate or the long-run sustainable rate of unemployment is. So we're running below that, and we have been for a considerable period of time. And we have only grazed 2% inflation for a short period of time. And so we can't, our goal is not hit inflation 2% every once in a while, and our 2% inflation target is not a ceiling. It's supposed to be a 2% goal on average. So if you're only grazing 2% and not even on a sustained basis, then you're not really achieving the goal. So we find ourselves in this situation as a Fed, and I'm talking about all of just the central bank in general. We find ourselves in a situation where the traditional model isn't working as it traditionally has. And the flattening of the Phillips curve and this wedge that's coming between unemployment and inflation is not brand new, but it's certainly something right on our plate today. And it's surprising in many ways that you could see unemployment go down so far for so long and not see wage growth really start to pick up and inflation also pick up. So what is a person to do? So it's basically, so now what? What do we do? Well, that's where I want to spend the rest of my time. And the answer is, there is no complete and total answer. It's not like we can just go and look in a giant book and figure it out, or if we just had better data, we would know. So we have to collect a lot of information. And we have to be able to use that information in an effective way. And it goes a little bit outside of what I was taught to do as a researcher. As a researcher, you're taught to use data, test for significance, think about a model, estimate a model or calibrate a model, use every mechanism you have to figure out what the truth is, or what as close as you can get. But now we're in this situation where those are not alone going to tell us what to do. And I don't have anymore, one of the big differences between being me now and me in September is I don't have the luxury of saying, I don't know. I have to actually have a decision every 8 times a year about how I think about it and what we should do to serve the American people and create this healthy and sustainable economy. So what do we do? So, and this I think most of you probably know, but I think it bears re-emphasizing because we are in a pretty uncertain period right now in this regard of just, why isn't inflation going up, and then what should we do? And the title of my talk is Achieving Full Employment in a Modern Economy. And that's a big tent. It allowed me to figure out what I wanted to say long after I gave them the title. But the truth is, the thing that's on the top of my mind right now is, what does full employment mean when every estimate I can do, whether I'm using models or I'm using data to get a long-run sustainable rate of unemployment, gives me a number that's higher than the current rate of unemployment. And I'm not seeing inflation. So what am I to do as a policymaker? What does full employment mean? Because we traditionally think about it in this inflation-unemployment trade-off space. If you don't think of it that way, you have to go to what I would consider allocative inefficiencies. When do we just run the economy so hot that things start to blow up, people exit school or whatever, but we don't have any mechanisms for really quantifying that. So in this space, that's the question I'm asking. One way people have put it is, do we have room to run and find it out? But what does full employment mean in this space? So how do I figure that out? Well, the first thing we do is we don't abandon our data and theory. We double down. We've estimated a Phillips curve in every possible way you can imagine. And then I've got people doing theoretical models asking what happens to a Phillips curve if bargaining power changes and all kinds of things. What happens if the world blows up? What happens to the Phillips curve? So we're digging deep on data and theory. But importantly, we also really look for business and market and community context. And there it's interesting because I was taught that anecdotal information, even in large scale, is still just anecdotal information. But sometimes our models and our data are not going to tell us the whole story. And so I really do have to get out there and ask people, how does the world work from your business line? And then try to source that and not completely say, well, the last person I talked to said this, so that must be what's going on, but to try to source that and figure out how that fits into our model. So I spend a lot of time in the community asking people these questions. And the question is, why aren't you paying more? And an answer I have gotten is this, that at some point, $20 an hour is too much if I'm selling pizza. Because if by the time I rent the space and sell the pizza, my price point on the pizza, if I had any profit at all, would be too high. So I simply close up shop, or I spread out the locations of my pizza places, and I have Uber Eats deliver the pizzas in between the old localities. So it's just, those are the kinds of things that help me understand what wedges are forming in between the normal models and data that we use. The other thing that's important is to seek out alternative perspectives. And I tell people, often I get asked, who do you rely on the most? And I say people who don't agree with me. I find the people who don't agree with me. The people who agree with me, aren't helping me move my mind. They're not changing how I think about things. So I look for people who don't agree with me, and then I want to follow up with them. So if you are particularly disagreeable in the Q&A, you can count on me to find you in a good way. So, this is just to say the same thing. We have to analyze, listen, and challenge. And this is confusing to the public a lot of times, in my judgment, that we are not always sure as economists what is the right answer, and so you have to think about it, you have to analyze the data, you have to listen to people, and you have to challenge. And that level of uncertainty about that there's no truth with a capital T, at least one that we can see easily, can be confusing, but I'm going to argue that that's the best way to be a policymaker, is to be a little bit not sure. And I'm more comfortable being not sure, perhaps, than many people are, because I took such a crooked path and I wasn't sure what I was going to do the next year, much less 10 years later. But I think this level of comfort with uncertainty and still being able to be making a decision and putting your best foot forward each time you meet is an important component of being an effective policymaker. So let me conclude with this. This is a calendar. It's one that I now pay a lot of attention to. The red X's are when we meet for the FOMC, those are the months. And so it is true that 8 times a year we have to go, whether we know the truth with a capital T or not, and actually figure out what's the best policy prescription for the American people to keep the economy healthy and sustainable. And when I do that, here's what I do. And I think this is good, it's good practice in research, this is where I learned it, and it's good practice in policy. I'm confident when I go in that not that I have the truth, but that I have looked at every piece of evidence I can possibly find, and I've made the best judgment I can given that evidence today. And then the very next day, I'm curious about whether that was what the new information is going to be, and whether the evidence will lead me to change my mind or refine my view. And the most important quality of a policymaker is to be humble. If you're not humble, it's hard to be effective. And so when I talked about bringing my whole self to work, one of the things that I was mistaken about is when I first started out, I crossed that threshold and I thought that confidence and no sign of uncertainty, no sign of not knowing, was what people expected of me. That was how I was going to be part of this club, that I was going to have this amazing certainty, because in grad school, there's a lot of insecurity that gets translated into posturing of certainty. But what I learned about being my whole self at work is that it's actually a really great trait to be confident in the answer you've arrived at today, be curious about the answer you'll arrive at tomorrow, and be humble enough to change your mind. And I tell young people, there are not that many of young students in the room, but if you are a student in the room, that's a good quality in your research. It's a great quality. It's a great quality in policymaking. And I personally found it's a great quality in life. So I will conclude there, and then Mark's going to ask me all the hard economic questions you might want to have the answers to as well.
That was great. So you've been at the many places I could go, but you've been at the San Francisco Fed now for more than 2 decades, but now president of the San Francisco Fed for just a few months. So what has surprised you the most since you've become president of the San Francisco Fed?
So the most surprising thing about being the president is that every single word I utter makes it onto the front page of a newspaper of some type. I mean, I wake up and I'm thinking, oh my gosh. So I have, you kind of know that. And Janet Yellen, who's one of my great mentors, told me this, but you don't really understand it until you wake up and you look at the paper and you say, okay. And so that's the most surprising thing, is that the position itself, and it's the right thing. I mean, I'm at the table, I'm making monetary policy, so of course that's going to be an amplification mechanism, the role. But I was not completely, it's just until you experience it, you don't know it.
Great. Okay, so there was a lot of talk, let's say a month or two ago, I think it's quieted down a little bit, but about the risks of a possible recession. Things are obviously 4% unemployment right now, and GDP growth has been pretty healthy, but as you look at the economy right now, with the information you have, the trends and so forth, how are things looking?
So there was a lot of talk about the recession, so let me just talk about that for a moment. So we were going strong, things were looking really good, and then we get to, say, September, and financial conditions started to tighten. And what was interesting about that is if you look at our interest rate policies, our interest rate increases, and I wasn't a policymaker at the time, but you just look at the Fed raising rates, the surprising thing before September is we didn't have much movement in financial conditions. We were a little bit the debate in the Fed and outside of the Fed was, have we lost some of our power? Because we're raising interest rates and we're not seeing a tightening of financial conditions more generally. So then in September, you start seeing that tightening, and that starts slowing the economy. You saw the housing sector slow and other kinds of things. And that basic process, many of my contacts started asking, do expansions maybe they're just getting old in the tooth. Maybe it's just gonna wear out. Maybe we can't get a soft landing was the undertone there. But I kept trying to reassure people that recession or expansions don't die of old age. That's what the research says, that they're usually, as Bernanke, Chairman Bernanke put it at the AEA meetings, they usually are murdered by the Fed. But all that aside, the contexts were still pretty nervous, and then we got the stock market corrections that came, and that made people even more nervous. And so the mood turned decidedly sour. But we didn't see it showing up in the data in a real way, but we are starting to see it percolate through now. And then we have headwinds. I mean, we were going gangbusters in part because we had a strong domestic momentum, and then we had significant tailwinds. Now we have more significant headwinds. We have tighter financial conditions, slower global growth, a lot of uncertainty. I don't think Nick Bloom is here tonight, but the index they track, policy uncertainty has spiked both globally and domestically. And research at the San Francisco Fed has shown that uncertainty alone takes away growth and raises unemployment and holds down inflation. So all of those factors mean the economy is slowing, but there's nothing on the radar that says we're slipping into recession.
There are these indicators, or sort of read recently, like 7 million people behind by more than 3 months on their auto payments, or with the shutdown, a lot of people not having much cushion. So there are a lot of people sort of on a knife edge, right, in terms of economically, with but in any case, so that's the national picture. So you're charged with 9 states, and I would really like to talk the rest of the time about Hawaii, but
well, I think Mark's going to be a new visiting scholar.
Right, I know, that's right, and you
Residents
signed me to the project on the Hawaii economy, but the California economy, people here are pretty interested in. So we're, I think, 40 million. There's the Bay Area, which is, I think, about a quarter of the state. But how's California doing overall? So
California is doing very well overall. And California is a microcosm of the U.S. economy in that, I go all over California. And if you go to the Central Valley, that looks different than the Bay Area, than even LA, than San Diego. So we have a lot of heterogeneity. But overall, our state's doing well. We are doing better than the national economy overall by most measures. But I want to go back to the question you just asked me, the point you just made about many people still live very close to economic insecurity, which I know a lot about from my upbringing. And what is true is that even when you get a very strong economy, some of the problems we have, that would be housing affordability, not enough savings to pay bills more than $400 worth of savings. So if you've got an economic shock, you really don't have, for some Americans, many Americans, you don't have enough reserves to make it through that shock in a very easy way. It's hard for, I think, many of us to think about what that's like, but that's a real problem, and it's certainly true whether you're in the Central Valley or LA or the Bay Area. And a hot economy overall does not necessarily trickle down equally across the entire distribution of income. So we remain having these problems, whether you're in California or the US, of inequality, despite the fact that we have a strong economy. So a strong economy is a good thing, but it's not a panacea for some of the other structural problems that we face. And I'd say the same thing is true in California. We see housing affordability being a real issue here.
Great. So I'm right now teaching Econ 1, and one of the topics that we hit a lot is productivity and the importance of productivity over the long run to living standards. And there's some recent, if you look over the last decade or so, at least as it's officially measured, productivity hasn't been so great. And I think there's somewhat of a view in Silicon Valley especially that that's mismeasured. We're not capturing a lot of new goods and free goods and so forth. But just generally, would you say that you're been pretty low relative to, let's say, previous decades? Are you optimistic about productivity? There's automation, AI, which has obviously the disruptive type effects. But can you talk a bit about how you think about productivity going forward?
So yeah, the productivity story, the question gets asked probably more than almost any other question, other than what am I going to do with interest rates. But on productivity, I'm very influenced by the work of one of my colleagues at San Francisco Fed, John Fernald, who is a well-known expert on this issue of productivity. And he did with some co-authors a paper that asked a simple question. Are we simply mismeasuring productivity? Because all these goods being created are not in the accounting, and this is just mismeasurement as opposed to a slow period of productivity growth, or a period of productivity growth that, while it looks like it did in the 70s, it's not as fast as it was in the 1990s. What he found with his co-authors is that we're not really mismeasuring it in the official statistics. A lot of the gains that you've referenced are on things that affect our well-being, but they don't affect how productive we are at work. The joke is famously that Facebook doesn't make us more productive at work, so it makes us less productive at work. I don't know if that's true for us, but for lots of millennials, it could be. So, but either way, I think there's a big difference between some of the things we see being created, which are really great for all kinds of well-being issues, make consumers easier, Uber Eats, other things, but do they really affect business productivity? We haven't seen it in the data yet. All of that said, that doesn't mean that we should be pessimistic. A lot of times things get developed and then they don't diffuse into businesses until much later. So I think the technologies themselves, we haven't even begun to think about how they can affect businesses, and I'm optimistic that we'll see an impact of AI and other things eventually. I don't know when. But for now, just a ground up accounting on productivity, I have trend productivity growth at about 1.2%. And if you add the slow growth in the labor force of 0.5, 0.6, you get growth of right under 2% as the potential growth rate of our economy.
Right. So, I mean, on productivity, it is difficult. I mean, we've touched a little bit on this as the economy becomes more service-oriented. So healthcare, for example, is a tough area to think about productivity. So I think it's just going to get ever more and more challenging as things like healthcare consume a larger share of GDP for us to get good measures of this. But, and so there has been a fair amount of talk recently. There was an event on campus quite recently regarding the federal deficits and the level of the debt. And I think there's a view that I'm hearing more often than I used to, that it's actually not so problematic if we run a really big deficit and if we increase the debt a lot. And so I'm curious to hear your take on how troubled are you by the deficit and the level of the federal debt going forward?
Where are you going to these conferences?
Well,
no,
I don't know. They're
no,
on campus.
Yes, I'm just kidding.
Yeah.
I myself, I think that anytime you live for a long period of time outside of your resources, that's never optimal. And it's going to be an important thing. We've been facing these problems. I mean, Mark and I have both studied disability insurance, Social Security, Medicare, these big entitlement programs that are weighing on us. We have an aging population. We have we face slower growth for that reason alone. This is a global situation. So at some point, there is going to be this rubber meets the road when we have to decide how we're going to allocate our resources across the population. And we are not making those decisions now, in part because we run deficits and we take on debt, but eventually we will have to. And when we have to is not known to me, but I think that's part of the conversation we should be having. It's just, how do we live within our means, and how do we allocate our resources across a population that has many needs? And how do we think about those trade-offs even? And this is a situation we're not alone in facing in the US. Other countries are facing it as well. And at some point, there will be a period of reckoning of the books.
Great. So I've focused mainly on domestic questions, but I'm curious to hear your thoughts on how important current and recent trade disputes are for the U.S. economy and going forward, and how these things get resolved.
So as you might imagine, we spend a lot of time trying to figure out how trade disputes and debates will affect the U.S. economy and the growth rate. And here's what we've learned so far, that if you just add up the effects of the different tariffs that have been imposed and the counter tariffs and things, you don't see a big effect on the overall economy. If you're in a particular sector, or importantly a particular region that's heavily invested in a particular sector, you see the pain there, but you don't see this having a huge effect on the real economy. And when you add up all the numbers, the effects on inflation are larger oftentimes in forecast than the effects on growth. So prices are higher if you're closing your economy down or if you add tariffs to them. And the real economic effects are just a little bit lower. And we're talking a tenth or two on either one of those two variables. But the impact of uncertainty on the economy could be the more lasting impact. So avoiding these tail risk events where we have a closed economy completely, and then we are having a serious decline in our potential growth rate and a serious increase in our inflation rate. Avoiding those types of things, the uncertainty impacts are actually pretty substantial and worth considering. So that's what I focused into my forecast, and that's what I think of as another headwind. The global uncertainty, trade uncertainty, government shutdown, other kinds of things, these all contribute to uncertainty in the economy.
Great, so I'm just gonna ask one more question and then I'm gonna open it up. So you mentioned students, and I'm curious, your take, you've probably given some thought to how to get students more interested in economic policy or positions at the Fed. Does the Fed hire students or people, recent graduates, or is it more looking for, veterans? So can you talk a little bit, though, about your thoughts on inspiring students to get excited about these issues?
Sure, so, I think that, I've given personally a lot of thought to this, and we at the Fed given a lot of thought to this. So the answer to the question is yes, we hire a lot of newly minted students, but not just in economics. I mean, we hire research assistants in the economic research department, but the Fed does a lot of things. I mentioned at the beginning of my remarks that we do the payment system. We are responsible for a safe and sound payment system. We do financial regulation and supervision of banks. All of those places hire newly minted graduates and are eager to get students in. In fact, one of the big goals I have when I was interviewing for the job, I said one of the risks the Fed faces, especially sitting here in San Francisco, is that we're competing with the giants of the high-tech firms, and getting anyone to major in anything but computer science is a challenge, and getting anyone to come to me at the Fed as opposed to going to one of the big three is difficult. So we do hire them, and we're making a big push. I actually think it's very important for us to encourage more young people to major in economics, public policy, but it would be difficult to get them excited about it in some of our current environment where we are, public service and public administration is not the apple of anyone's eye right now. There's a lot of disagreement, and most of the times you see people disagreeing so much that they go in separate corners and they're not really debating the issues. So part of what I'm doing to try to encourage more people to do it is not just say there's another career besides computer science. It's also to say that, there is a way reasonable people can disagree. They can come to the table, they can sort it out, and they can be, to end with the thing I ended my talk with, they can be confident in their views, they can be curious about your views, and they can be humble enough to change their mind if you influence them. And if we can get that back into the regular discourse, I think that is something that in academia you always have. It's the core of how we do our business, but it's not necessarily something that we see demonstrated every day in more political discussions. It is something that I'm proud to say we do at the Fed. So it's a way that I think we can influence that discussion.
Okay, great. So that's it for my questions. I want to open it up now for questions from the audience. We've got right in the back, Barnaby.
So this may be one of those questions that Mary likes, but it's actually for Mark. So you said
question for me.
Talking to more and more people who think it's not a big problem with the debt load.
Right, because of the low interest rates.
Right.
So forth. Yeah.
So I literally just read something that says we're currently paying on the $22 trillion of debt about $364 billion of interest.
That sounds about right.
Which is 1.65%, which sounds about right.
It's a lot. That's a lot. Yeah, it sounds high, but it's a lot.
So when you talk about humility, when Mary talked about, how easily that could explode and become a real problem virtually overnight, because interest rates don't always necessarily rise just because of, quote, inflation, but maybe because some people stop wanting to buy our debt. Talk about that amongst yourselves.
No, I'm personally very worried about the deficit and the debt and the vulnerability to swings in the interest rate. I mean, I've seen projections indicating that over the next 7 or 8 years, the interest payments are going to go from that current 365 to, I believe it was 912 billion, 912 billion, which would be significantly greater than we spend on national defense. So I think that's a problem, and that's that's not even assuming a very large increase in the interest rate. So I'm pretty worried about it. So when I was citing those things, I thought that was unfortunate that there is. So anyway, I don't know what your thoughts are on it.
Well, so I agree with Mark, and I'll just add to it, since I don't need to restate what you said. Well, I think that any time we have such a large debt, that it will influence the discussion about what we can do going forward. If we have already a large overhang of debt and a large deficit, then we're not thinking outside of the box about what things we could do to help improve the economy or the country. We're thinking just about today and how do we achieve, getting the. We're making short-term decisions that have long-term consequences, and that long-term consequence will ultimately mean we have to make trade-offs that we didn't plan to make. And somebody else is going to have to make them. Some other generation, in all likelihood, will have to make them. So I think it's a real problem. And I think one of the responsibilities we have in at least my age group and the age group of people here is to basically ask the question, how can we make this situation more sustainable so that the people who inherit it don't have such hard trade-offs to make? And so I'm in the camp of worrying about it, not thinking it's not a problem.
Anat, over here.
Okay, I'm Anat Admati. One of the things you didn't talk about much, you said you had one tool, and that's the interest rates. But just at the very end, you said, oh, we do a lot of things. We do financial regulations. So some of the reasons you're in this bind on interest rates is, of course, we had a financial crisis. And the question is, was the Fed there? Well, the Fed was there, and the Fed was one of the regulators that spectacularly failed. Now, after the financial crisis, in terms of engagement and humility, I would make a distinction, and I can go into that, but not here, about who was engaging and who wasn't engaging among the people there. But most recently, in coming back to the San Francisco Fed, you are regulating, supervising and implementing Fed policies with respect to some of the biggest banks. And one of the last things that Janet Yellen did before she left was a step against Wells Fargo Bank because of the numerous scandals related to its own practices and conduct and constraining its growth and other things. So there's plenty going on corporate governance of these big banks, and you are supervising those institutions that have brought us to, extended the recession, if not caused it, let's just say. My question is, what do you think is the role of financial regulation in all of that, and in the unhealthy levels of private debt that we may have, and the use of private debt for mortgages and education, student loans, etc., to fund what things we want people to have, where the private households that undertake those debts are often the ones that, again, don't spend and exacerbate recessions, whereas the lenders are kind of poorly supervised, I would assert. So how do you view that as part of the Fed's mandate and helping the overall objective?
Yeah. Okay, have it.
Yeah.
Yeah.
How does she
so
view
have at it. I don't know.
So let me just take the part that I thought was a question and think about that. So the question is, what role does the Fed play in financial stability and thinking about the financial sector. And I started off by saying we have a role in financial regulation and also financial supervision of financial institutions. And one of the things that I'm proud about is that the Fed, after the crisis, did a deep dive into where did we miss things. I'm not saying that we didn't miss things, because we obviously did miss things. But we looked carefully at what we missed, and now we're monitoring those things we missed. And the important thing is you have to always know that you're likely to miss more. You could be likely to miss things in the future. So what do we do? So one thing we do is we have, and it was just released maybe a month ago, the quantitative surveillance report. So we have been doing that for a long time, but we've released it to the public, and it's looking at the financial sector and saying, where do we see pockets of concern? If you just were doing a heat map, you might say, green, yellow, orange, red. Where do we see things outside of their norms and in ways that would be helpful? I think this general monitoring is incredibly important and can't be underestimated in its value of just collecting more data, looking at those data relative to previous norms, and asking, do we have points of concern? The second thing that needs to be done, though, is not just to collect the data. You actually have to consider the data and then follow up with the data on what do you see. And here is where the contexts I talked to are very helpful. Not a panacea, but very helpful. So one of the things that's really different this time than just 10 years ago is that households are much better positioned in terms of their leverage than they were in their predating the financial crisis. So that's a positive, that households deleverage quite a bit. They haven't really increased their leverage to extreme levels, and that gives me some comfort, I guess, would be the right word, comfort that we don't face the same systemic problems across households and all the pain and heartache that those households suffered who lost homes and businesses, et cetera. So I think those are the ways to approach it, is to look at the data, recognize that you want to be as complete as possible, ask as many questions as you can, and always recognize that you have to keep going even if there's no book of data, no book of analysis that you can say, well, that's it, that's all we need to do. It's important to stay invested and in the context space, asking businesses, what's the next thing that we should be looking at? One of my favorite questions to ask my business contacts and my financial contacts is, what keeps you up at night? What worries you? Or where is the hot market and why aren't you worried about it? So these are questions that we learned to ask more frequently after the financial crisis, and ones that I continue to ask. The final thing I'll say about this is we take our role as supervisors very seriously, and that is top of our minds. And so while I said that I spent most of my time today, all of my time, talking about monetary policy, we take that role of a supervisor very seriously and are actively involved in executing on the regulations that are set by both the Board of Governors but also other regulators.
So we're going to try to, all right, we've got 6 questions and 3 minutes. So what I'm going to try to do is we're going to try to do it. So we did this last month at the Bay Area Council Economics Institute. We're going to get questions from a bunch of people, and then we're going to let Mary do her best. David, you're going to start. Right. Okay. And then John, and then Peter, and we had over here too, and Andrew. Yeah. Okay. Great. And then Hamilton. Yep. So let's see.
First of all, thank you for being here, and thank you so much for talking about your unconventional way of getting to the Federal Reserve. I'm going to keep this very simple. Given what a good leading indicator the unemployment rate is, and given what's happened over the past couple of months, right, and given we're starting to see the inflation rate roll over, in fact, you could say some of the Federal Reserve's work in other Federal Reserve banks is showing some disinflationary pressure starting to kick in. Do you think the Federal Reserve will reevaluate quantitative tightening before the end of the year?
Okay, now John Taylor.
So I loved your wedges and your charts and your scales. The last wedge, love the wedges and the scales. The last wedge, maybe we're missing some things, like maybe inflation is low because of the policy of inflation targeting, right? I mean, we didn't always have that. And there's also the question about where the interest rate should be normally. big debate, as you know. So where do those two factors figure into the scales and wedges?
Okay, right behind, right here. Yep, yep. And then Peter. Yep.
First of all, before my question, I just want to comment as an economics major here at Stanford. There's a lot of incredible peers and students that are interested in research and policy, so that's something to be optimistic about. And my question is, I think in the last decade, with the emergence of the gig economy and a lot of contract and part-time jobs, how does the Fed sort of look at this sort of employment in terms of like full employment, and how does that sort of factor into the equation, if at all, when you think about monetary policy?
Great. And then Peter, and Andrew, and then Hamilton. And we did start 5 minutes late, so I hope people will bear with us if we go 5 minutes.
Thanks for being here. In January, the FOMC meeting produced a series of notable policy and statement changes that has led some analysts, including myself, to wonder if the Fed reaction function inputs changed or the reaction function itself changed towards something more targeting perhaps more inflation at the hotter part of the cycle. What's your perspective on this, and what do you think the Fed should be doing with this reaction function? Thank you.
Andrew, and then Hamilton. So we're 4 down, 2 to go. And it's not as broad as it was when we did. Yeah, back there, Andrew, back there.
It's deep.
Then, yeah, so.
Hi, Dr. Daly. My question is more related to your background as a labor economist, in particular focused on the rate of employment. More importantly, the idea of underemployment that I feel isn't being discussed as much in a lot of circles, but may have a lot to do with your overall Fed impact. So talking about underemployment a little, love to hear more about that.
Finally, last but not least, Hamilton.
Thanks for coming. Your story was simply inspiring. It just blew me away. My question is whether how you think about the amount of ammunition you have in the event of something really ugly happening. So with very low interest rates and with all the debt we're talking about, whether there be political will to do something on the fiscal side, are you comfortable that we have ammunition if something ugly happens?
Okay, good luck. I wrote them.
Yeah, good luck.
Quantitative tightening, inflation targeting, gig economy, underemployment, ammunition. So I think, and I think I missed Peter. Anyway,
my partner's father famously always says, "Good luck, baby. You're going to need it." And so I'm kind of thinking this is he's going to give me that.
Yeah.
Okay, so where am I starting?
Quantitative tightening.
Okay, so the
reevaluate.
Yeah, let me just. So in January, in addition to the release of our statement, which was noted changed and had patient, and many of us have been out talking about we'll be patient about further rate increases, conditional on economic and financial conditions. We also released our restatement of our normalization principles and our balance sheet principles. And in that, it was, and Chair Powell said this at his press conference, he said, we will be thoughtful about financial and economic conditions. So unlike an idea where you're simply, you're going along and you're letting the balance sheet roll off and normalize on the famous phrase on autopilot, that we, when we were far away from normalization, that was a totally reasonable statement. But as we get closer to the neutral rate of interest, which I think we're very near, and also the rate, an ample reserves regime will call for a larger balance sheet than we had before the financial crisis, then both of these things mean that we have to be attuned as we find the right level of reserves, not only to reserve demand by banks, but also to the financial and economic conditions, that we don't want the balance sheet to be working at cross purposes with our interest rate policy. And I think that's the part of this that is important to emphasize, is that those two are meant to work together and not at cross purposes.
Inflation targeting.
So inflation targeting. So I'm not exactly sure, John, where your question was, but here's how I think about it. That an important component of the flattening of the Phillips curve, which is why the scale at the end looked a bit different, is that we have interest rate targeting. So now if the Fed's credible and we say we're going to hit 2%, it's going to be very difficult, or more difficult, for us to find a real relationship between unemployment and inflation that is as powerful as the one we had before we had a credible Fed at 2%. It's just endogenous now. If we lose our credibility and it goes back up, then we'll have a great Phillips curve, but we'll have lost the credibility. So the way I like to think of it is well-anchored inflation expectations are part of why we have a flat Phillips curve. But it's also important to keep well-anchored inflation expectations. So that's why we have to communicate so well what our reaction function is, and that we have two mandates: low and stable prices, or inflation, and full employment. And our goal, our 2% target, is a symmetric one. So on average, you want to hit 2%, but not, you think of 2% as a ceiling.
Gig economy and unemployment. Underemployment. Let's try to do that.
So we have research at the San Francisco Fed that's looked into how big is the gig economy. And while it's like online sales. While online sales get bigger every year and they get a lot of attention, they're still a minor part of overall sales. And the gig economy, while it gets a lot of attention and is a growing sector, is a minor part of all employment. And the BLS came out with that and said that same thing. And so it is not moving the aggregate employment situation as much as it, well, one we think of here in this area where the gig economy is probably, if it's as big here as it is anywhere in the United States, but it's also getting a lot of press because it's new, but it's not materially affecting overall employment. It does, and this is the final thing I'll say on it, it does actually help smooth income. That's one thing we do know, is that if you look at who's using the gig economy, Uber is a great example. Who's driving for Uber or Lyft? It's often to do income smoothing. And that is, so far, the well-being effects might be larger than the employment effects.
Underemployment,
underemployment, yes. Yeah. So we're very focused on this issue of underemployment. The way that I think about it, and we have research at the San Francisco Fed, again, that looks into this, this research by Rob Valletta, who also did the gig economy. If you look at part-time for economic reasons, that was something that spiked a lot in the Great Recession and stayed high in the aftermath. But it's come down substantially since then, and now is very close to what we think of it as its trend level. And so then it's the underemployment that's voluntary is not something we're trying to push against. The underemployment that's involuntary, that people say I'm part-time for because I'm not allowed, I can't get a full-time job, that's a different thing, and that's come back down. If you look at all the series that we measure, what is remarkable is most of them, all the different measures of unemployment that include unemployment and underemployment, they move together. There's always a gap between them because they're measuring different parts of the population, but they move more or less together. And the big exception was this part-time for economic reasons, which has again come down. So I think it's important to keep on our radar. We look at it as part of the dashboard, but right now it's not sending us a signal that is different than the one we're getting from the aggregate unemployment rate.
Okay, so let's try to combine these last one in a 60-second or less answer, because I'm way over. We've broken the record for longest over. So it's that function of you being so terrific. But reaction function, has it changed, and how much ammunition do we have? So
okay. Those are really different questions. So let me do the best I can. So I'm going to start with ammunition, and I'll close with the reaction function. So that's certainly something we're thinking about. And the Federal Reserve System, I don't know if you know this, has in November announced it was going out on its own listening tour this year, and we're hosting a conference in September on the cost and benefits of a hot economy and what's the importance of how should we think about the long-run framework. And the reason we're revisiting this long-run framework has a lot to do with the fact that we're in a low interest rate environment, we have low potential growth, we have an inflation target of 2, and the chances we're going to hit the zero lower bound are increased in their frequency from just a decade ago. And there the question is, what tools should we be using? And we have a toolkit that we use rolled out in the aftermath of the Great Recession. So we have, in addition to interest rate policy, of forward guidance and the balance sheet, quantitative easing. But there's also other things that people have talked about: negative interest rates, price level targeting, nominal income targeting. So we're in the process now as a system of collecting outside viewpoints from businesses, communities, and academics to think hard about what should our long-run framework be. Not to dismiss the dual mandate, just to think about how we should execute on it. The reaction function. I'm going to speak for myself now, and the way I think about my views in January versus my views in December is in December it looked like these headwinds were forming and the mood was turning a little sour, but I wasn't quite sure how, well, one, we were still below my estimate of neutral, and so the economy was still being stimulated by policy. And I wasn't sure how much the economy was going to be self-bridling to bring it back down to a sustainable growth rate. In January, I'm looking at the economy has more self-bridling than I thought it had just 6 months earlier. So it's restraining itself more, and we're now facing these headwinds I mentioned at the beginning. We have slower global growth, tighter financial conditions, and a lot of uncertainty. So we've raised the interest rate to something that I think is in a hair's breadth of neutral. Since there's large confidence bands around that, we're in a hair's breadth of neutral. So this calls for me to be patient until we see either inflation starting to get up to 2 on a sustainable basis, or even over 2 a little bit, so we can get 2 on average, or we see other signs of overheating in other markets, and we haven't seen that yet. And somebody asked me a question about the unemployment rate going up of late. And one of the things that I've noticed in the unemployment rate going up is that's because new participants are joining the labor force, or people are exiting the labor force at a slower pace than they used to. And so this is all signs of a positive. And as long as new people start coming in, or people who would normally exit at retirement age or something stay in, we have more potential supply of workers that we had. And so that's going to grease the wheels of further growth. And that's a good thing, not a bad thing.
Okay, a great note to end on. Thank you so much to Mary Daly.